In case you have missed the memo, Alibaba has returned to its pre-stimulus valuation. And this really depends on whether you're a cup half full or cup half empty investor. I'm proud to announce that in this historic run-up from the sub $90 range before the stimulus announcement to its peak of roughly $118 per share, I've not gained or sold a single share throughout this entire episode. So yes, I'm still a fellow backholder. But anyhow, that's not the focus of this video. So last Friday, Alibaba has just recently reported their earnings. So this is naturally just an earnings update. And just to jog your memory a little, this was my previous conclusion, the June quarter ending 2024. So we are hopeful for a Chinese consumption recovery. So the leadership and strategy transition has been painful over the past 2 years. And there were many shakeups and loss of confidence. And they haven't really been producing good enough numbers for investors to bite. And here's the bottom line for the previous episode where I talked about Alibaba's valuation remaining attractive, the quality of the company is still under scrutiny due to competition and execution. So buybacks would act as some sort of a support as long as they maintain their cadence. And there's nothing much to take away from their previous earnings report. So after the Friday reporting, what exactly changed in this new quarter? So the new conclusion is nothing changed. And thank you for watching. So I'm making this conclusion half jokingly, but largely speaking, I think the investment thesis is still the same. There was nothing mind-blowing, there was nothing substantial, and I guess the whole pump due to the stimulus was not being backed or substantiated by very hard and tangible numbers. That's why investors were disappointed. I think there's two parts to this discussion. One is on the business, another one is on the stock price and the valuation itself. So I think it's generally a B- report card. It's lukewarm. There was nothing particularly out of the blue, so this video will probably be very short. And also, investor sentiments have yet to turn around the corner, although the business growth might be seeing some signs of recovery. But not many people are buying into it yet, especially after the stimulus merry-go-round. Took the liberty to basically look at the last 10 years of their growth history. Previously, Alibaba was owned by a group of growth investors. You can really see that their past growth rates historically was in the range of like 40 to 60%. But I think after the crackdown, after the pandemic, after the slowdown of the buyers and merchants, etc., you can see that we are really in single-digit growth rates. But at least on a positive note, I think the operating income on a trailing 12-month basis, they're still on some sort of a upward trajectory. Although I have to acknowledge the fact that they're probably not growing as fast as before, and that growth expectations have to kind of be priced into the valuation itself. So I've got good news. For those of you who have missed out on the previous opportunity, Moomoo has since extended the sign-up promotion period until the end of November 2024. So for new users, don't miss this opportunity to enjoy a starter kit worth up to 1,034 Singapore dollars. So have you ever wondered what would your investment look like if you committed to a recurring investment since 3 years ago? Well, if you go into Moomoo's app, under Accounts, More, RSP Calculator, key in any ETF that you are interested in, the amount and the frequency, and you can backtest the results and the quantum of the strategy. So for example, putting in $50 per week in an ETF tracking the S&P 500 from November of 2021 until today, 3 years later, you would have put in a total of $7,800 and the account size will be well over $11,000. So to join you in this journey, I will also commit $50 per week in Moomoo's RSP, regular savings plan, and that would mean one less fanciful dinner out per week on my end. So new users can also earn up to 1,034 Singapore dollars worth of welcome rewards. And this includes a 6.8% per annum guaranteed returns for up to 30 days on your first $80,000 invested with Moomoo Cash Plus. Please note that Moomoo Cash Plus is an investment product. So principal is not guaranteed and up to 30 days of the 6.8% per annum is guaranteed only during the promotional period. So after the promotional period, interest is not guaranteed. This is not comparable and is different from a fixed deposit or a savings deposit. So investment in any capital market products involves the risk of losing your principal. And on top of that, so at the lowest tier, you can deposit a minimum of $3,000 and complete 3-buy trades, and you'll get a stock bundle worth $70. So for those of you with more capital, you can look towards the upgraded rewards of up to 4 stock bundles worth $70 each and an Apple share worth 287 Singapore dollars. Plus, you get up to $20 worth of cash coupon exclusive reward when you sign up using my link below. And the campaign will end at the end of November, so you wouldn't want to miss it out. Link will be in the description below. And thank you Moomoo for sponsoring this video. Just a high-level overview in terms of their financial highlights for the 3 months ending September 30th. So I'm mostly just focused on 2 business verticals. Firstly, it's the China Core Commerce, which is the Taobao and Tmall group, and secondly, it's the Cloud Intelligence. I do understand that some of you are interested in the international vertical or even the Cainiao logistics network, but to me, I think they are not necessarily the main value or growth drivers. At least on the profitability front in the medium or short term. Ultimately, Alibaba is still a Taobao and Tmall group. They drive most of the profitability. They're investing heavily into the cloud, which is able to ride on the next growth tailwind. For the international commerce section and the Cainiao, I think they play more of a complementary role. But that said, I think on a top line revenue growth rate perspective, Taobao and Tmall, they're holding it there at 1% year on year. Cloud, 7%, there's a slight re-acceleration. International 29% seems like a sparkling point, but I at least for myself as an investor, I don't put too much emphasis there. And Cainiao, they are a supplementary component to the entire Taobao Tmall group. So moving down the income statement, I think we have a comparable profitability metric. Alibaba themselves, they use adjusted EBITDA, and you can see that Taobao and Tmall group, they are basically subsidizing the entire other business verticals. Even though I think we have to give credit where it's due, where the Cloud Intelligence group, they are improving in terms of profitability, 89% year on year. But likewise, I said international group, they're down significantly. The logistics network as well, it's down significantly year on year. Local services group, they are not substantial enough for me to really pay a close eye on, but it's good that they are improving in terms of their profitability metric. So if to just squarely focus onto the 2 business verticals, which is Taobao and Tmall and the cloud, if you're interested in their disclosures, I think they did put on some updates in their earnings presentation, but that's not where I'm gonna present on because those are quite easy to read. What I'll do instead in this presentation is to focus more in terms of the earnings call and to give you a summary of what the management is basically talking about. So in this quarter's focus, I think there's a lot of execution, not much strategic direction on new developments. All these has been said by Eddie when he first took over from Daniel Zhang, but I think here are a few notes from Eddie's statement, who's the CEO. So he said that monthly active consumers on the Taobao Tmall group reached a new all-time high. 88 VIP members, which is something like a Prime members in Amazon, they reached 46 million at quarter end. In terms of their monetization progress, they did implement an industry standard 0.6% software service fee while also providing rebates to SME merchants. So adoptions of 前站推, which is their marketing tool, continues to rise. The Double 11 shopping festival achieved robust growth in GMV with monthly active consumer back to growth and achieving record high. They are also optimistic about the government's macro stimulus policy, but I think at least from my own perspective, they probably have to say this even if they're pessimistic. Because let's not forget that they're in the China operating system. So a few things to note from Toby's statement. He's the CFO of Alibaba Group. He did say that they made steady progress in terms of their monetization strategy with accelerated consumer management revenue growth. They implemented the software service fee based on the percentage of GMV since September 1st. They spent roughly $10 billion and completed a 4.4% net share reduction for the first half of the fiscal year. They still have $22 billion in authorization, and the pace of the buyback is a function of the share price and how they determine value. So by 30th of September, there was also a net inflow into the Hong Kong listed share. It reached roughly 46 billion Hong Kong dollars, which is $6 billion, which is roughly 3% of the shares outstanding. And this was when they established their Share Connect or Stock Connect program, where they allow mainland investors to buy or to become an investor of Alibaba. So the free cash flow took a hit because there is a 4x increase in capex spending, which is capital expenditure. And this increase in capex spending is mainly due to their cloud investments. So it increased from 4.1 billion to 17 billion RMB in the previous quarter alone. And it's also due to the refund as they changed their monetization model and a change in their working capital due to the scaling down to some businesses. So the CMR revenue actually increased by 2% due to the online gross merchandise value growth, while take rate remains stable. So cloud increased 7%, mainly due to a double-digit public cloud growth, and their AI-related products grew at triple digits for the 5th consecutive quarters. So this is basically the summary between analysts and management on their earnings call. I just picked out a few key factors that I think you should know of. So there are quite a few number of questions about take rate, about the Double 11 event, about higher discount coupons and how it will affect Alibaba's bottom line, which is profitability. Because if Alibaba were to give out a lot of discounts to increase revenue growth rates, it would affect bottom line because earnings will be impacted. But I think long story short, yes, they did admit that they gave out a lot of coupons to drive traffic and volume, but so did others in the industry itself. So it helped shape positive future expectations and to ensure that the merchants grow alongside the platform, so they'll spend more on advertising the next time. So take rate is stabilizing, but you probably won't see explosive growth rate as there is an offset. So firstly, I think they switched to a new monetization model, which is the 0.6% GMV. So they claim it to be better, as well as the deepening of the penetration of their marketing tool. But there is also many new business models that they are pioneering that are in the growth stage, and there is a low monetization effort there. So I think it kind of stabilizes or kind of offset. So if you compare against a market average, there's still significant potential headroom to increase, and there is no data to back this up. I think you have to take the management's word. But I think the focus also is that they want to grow alongside their merchants and not just to focus on driving profits for Alibaba as a group only. They want to make sure that there's some sort of a win-win-win relationship. Now, there's some questions on the profitability of cloud, especially given the recent price decrease. So the expectations put forth by the management is quite clear. They say that the technology advantage matters and there is an importance in terms of a scaling effect. Therefore, they have been able to grow both volume yet also improve profitability as well. They prioritize in growing user base and to attract a lot of new users to use the models to deploy their application on the cloud, which will result in increase in use of compute power, storage, database, and other products. So they did make a claim that Alibaba is a full technology stack. So as long as people come to the platform, they have enough products to upsell and cross-sell. So the key here is to really drive the volume and to drive the traffic to their platform and to get them to be a user first. And we'll think about the monetization or how the profitability will come into the picture later on. So on the topic of the significant capital expenditure that's going to increase in time to come, it's a function of their knowledge, understanding of the short-term demand, and the judgment of the long-term demand. So it's not even possible now to fully meet all of the demand. So that's why they're making aggressive investments for the short term. So they view this cloud opportunity as a leapfrogging one, technologically speaking, that comes once every 20 years. So on the questions on buybacks, their US shares still make up a majority of the existing liquidity, but they're executing buybacks on both exchanges, which is the US and Hong Kong. They're not able to leverage on the PBOC swap program, which was announced during the stimulus week, and they never really explained much. I would like to hear more, but I think the analysts didn't really pursue further. But they did raise the $5 billion convertible bond and use the whole amount in the June quarter. And moving forward, they'll continue to explore various ways on financing, and they have an abundance of the renminbi onshore, and they're looking to land in the renminbi offshore and US dollars. So here's the bottom line, I think an overview to also just to square a few doubts why I look at operating income and free cash flow rather than the earnings per share or the normal price to earnings of Alibaba is really because it's quite noisy in terms of their bottom line earnings per share. Because they have to write up and write down their investment income. And as you guys might remember, at least in the quarter ending September 30th, there was this huge rally in terms of valuations. That's why they need to write up their interest and investment income. You can see increased 262%. But it's not necessarily in line with how we want to analyze the company because we want to look at the operations of the business, and that income is more predictable. A lot of this write up and write down, I think in the longer term, when you look at it from an investment point of view, their investment portfolio, if they're able to strategically invest and bet on those up and rising companies, this would naturally bring in shareholder value. But I think on a quarter-on-quarter basis, it's really just too noisy. So just looking at this, I guess the bottom line income from operations, they're up roughly 5% year on year. Now, moving over to the cash flow and balance sheet, This is 2 quarters ago, which is the June quarter. I think just to signify to you that yes, Alibaba is going into that investment cycle. That's why you can see that they're stepping up their capex quite aggressively. So in the June quarter, they basically doubled their capex. And in the September quarter, they actually quadrupled their capex. And I think if you look at it on a free cash flow point of view, it was being hit significantly because of a double whammy. Firstly, because they 4x their capex. And I think secondly, the net cash from their operating activities also took a big hit, mainly because of the refunds and the new change in their monetization model. That's one. And I think secondly, it's their effectiveness in terms of being able to drive the bottom line figure. So I think just looking at the share buyback story, they did post again in the most recent quarter. So you can see that the repurchase amount here, even though I know that it's a bit small, let me zoom in a little. They are basically stepping up aggressively in terms of their buybacks. At least over the last 3 quarters, they're stepping it up to around 4 to 5 to even 6 billion per quarter. And I think the repurchase amount, if you can see over the general trend, it's coming down quite significantly from, I guess, Q1 of 2022. So at its peak, they roughly have around 2.7 billion shares outstanding as of Q1 of 2022. And right now, they have around 2.27 billion shares outstanding. And that's a 16% reduction 10 quarters later. So if you do simple math, I think 16% divided by 10, that's roughly 1.5% per quarter. And they're stepping up the pace of buybacks at $200 to $220 billion in market cap. I think arguably it's still pretty attractive from a valuation point of view. But yes, I think it's business as usual. It's still trying to turn around, no doubt about it. But I think a lot of investors are now writing off its past glory as they hold on to their leadership title in a few industries like e-commerce, cloud, payments, etc. Whatever it is, they are trying to turn around the business. And they are basically also scaling up their capital expenditure for the cloud growth curve. And I think it really depends on the ROI of the Chinese market. But I think this is a business vertical that is proven, so it's not as risky as compared to, I guess, the early 2008, 09 or the 2010s, where I think Amazon was the trailblazer of this entire industry. There was a lot of uncertainty back then, so it's not as risky to pursue into that tailwind. But that said, I think the ROI is still quite iffy because we don't really know whether they are able to achieve AWS or Microsoft Azure sort of margins per se. On the growth rate front, definitely a notch lower because AWS targets the entire world, while these Chinese players mainly operate in the Chinese market and maybe a little bit outside of the non-Western hemisphere. So if you were to look at it from that point of view, free cash flow will definitely take a hit. And I guess that's the natural consequences of investing in a technology company that goes through into this sort of investment cycle. So I think the valuations are really just inconceivable, and there's a lot of fear being priced into it. But I think the same argument can be made over the last 2-3 years when they're locked into that valuation box or that range between, I guess, $70-$80 to, I guess, $120. In that range, nothing much is moving. There's not a lot of new catalysts. Investors are not excited. So I think it really depends on which side of the curve you're on. Parts of this question, one, which is the macro kind of environment, whether this too shall pass, and two, whether Alibaba is the correct company that is able to ride onto this recovery. They're currently at a $200 billion market cap, $50 billion in net cash after netting off all the debt. They normally, I use the keyword here, normally do 20 to 25 billion in free cash flow per year. At least in the whole economic crisis and slowdown, when we are arguing that 2020, 2021 was China's Lehman moment, and arguably even until today, they are still in the Lehman moment. They were able to hold this 20 to 25 billion dollar free cash flow per year until this whole capex cycle came in. That's when their free cash flow going to take a hit, which is why I noted that they are now in an investment cycle, so we can't expect this kind of numbers. But I do think that if they pull back in terms of their capital expenditure, they're able to revert back to this baseline assumption of 20 to 25 billion free cash flow per year. So they're buying back shares at 1 to 1.5% per quarter net, and share buyback is also compounding in nature. So I think to give you a flavor in terms of appreciating this 75% magical number, why is it so? Because I think firstly, when you think about it, an entire market cap at 100%, if I reduce 75% and everything stays equal, ceteris paribus, earnings per share, their revenue, whatever it is, I think we can kind of argue that there might still potentially be upside as the company keeps growing. But let's say that they don't grow. They continue on for like that for the next 5 to 10 years. Revenue hold flat, earnings hold flat. But what they're able to do is to reduce the shares outstanding by 75%. Everything holds same, actually earnings per share multiplied by 4. Theoretically speaking as well, the share price should also quadruple due to the earnings per share, same PE multiple, whatever it is, they're able to 4x. And I think based on the discussion just now, I did say that they have already reduced 16% of their shares outstanding from its peak. So going to that 75% magical number, 75 minus 16, we get 59. So at that 59% number, 59%, let's say that they still reduce 1.5% of their shares outstanding per quarter. So 59 divided by 1.5%, that's around 39 quarters. And 39 quarters divided by 4, that's roughly a 10-year time horizon. So at a 10-year time horizon, if you're able to quadruple, I think that's still a fairly good base case. If and only if, there is a lot of ifs and assumptions here, that they're able to hold their revenue, they're able to hold their profits, able to hold their free cash flow, I'm still committed to being able to buy back 1.5% of the company shares outstanding per quarter, and they just, the entire valuations of the market cap continues remaining around $200-250 billion. So there's a lot of assumptions here, but I think the focus, or at least my own main conclusion here, is that you really don't have to put much thought into the current value, i.e. guessing whether Alibaba is cheap or not, because I think everybody on the street knows that it's cheap. But I think you have to make sure that you are fine with many of the risks mentioned before, and also a lot of the assumptions that is being played here. So personally, I do think that downside is kind of limited and the upside is varied depending on the execution and the time. But I think the main factor or the main investment thesis really here is that heads you win because you have a lot of call options at the upside, which is, I guess you can look in terms of the entire macroeconomic recovery story. You can look at Alibaba's leadership transition. You can look at their execution. A lot of these things will drive those positive upside. And on the flip side, I think tails you don't lose much because valuations are cheap. The companies are aligned with shareholders. They're trying to buy back their shares. They're trying to invest into the future, and they're still trying to grab back market share and to grow the business. And they have some sort of a track record in terms of their execution, at least over the last decade or so. Of course, it's not the most exciting investment opportunity. You can't 10x in the next 3 years. But I guess this is a very good baseline in terms of how you should understand this investment opportunity, at least from my own lens. And if you have any comments, feel free to leave in the comment section down below. And I'll see you in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.